Hey everyone, welcome to this explainer. Today we're diving headfirst into the downright bizarre contradictions that are completely defining the 2026 market. We're looking at a financial landscape right now that's desperately trying to balance record-breaking stock highs against some seriously severe underlying economic fragilities. So let's just get right into it, because the data we're unpacking today tells the story of two completely different realities running right alongside each other. And it all really boils down to this one question. How can a market place in absolute perfection when everyday consumers are literally bracing for impact? That's the crucial question framing our entire analysis today. We're going to map out this extreme divergence. On one hand, you've got peak euphoria and massive wealth creation. But on the other, working consumers are showing some really serious signs of stress. And, this creates an environment where there is absolutely zero margin for error. Now, on the surface, the reality is that the market is currently pricing in, well, sheer perfection. Just look at equities and tech. NVIDIA has completely solidified its spot as the world's largest public company. We're talking a staggering $5.4 trillion valuation, driven by record data center sales and these new AI agents. That is up 67% over the last 12 months alone. Meanwhile, over in geopolitics and energy, oil prices are actually sliding. Brent crude is dropping because traders are betting on a narrowing gap for a U.S.-led peace proposal with Iran, hoping to resolve the war and reopen the Strait of Hormuz. If you wrap all this up in pure options euphoria, the Goldman Sachs Risk Appetite Indicator just hit its highest level since 2021. This is driven by an absolutely extreme surge in retail call option buying. We are talking about the 99th percentile of bullish sentiment here. Driving all of this surface reality is a phenomenon the data is actually calling the death of dividends. The massive hype surrounding the AI boom is actively draining capital away from traditional, steady dividend payers. It's like a giant vacuum. Companies are basically being told to plow those profits right back into immediate capital expenditures so they can win the AI race. Because of this, capital is just flooding into stocks where profits and dividends are really just hopes for the distant future. This is pushing the S&P 500 dividend yield down near an all-time low. The big takeaway here? Traditional dividend investing is lagging the overall index by the widest margin over a 3-year period since the absolute peak of the dot-com bubble back in March 2000. Adding to this whole futuristic frenzy, the government is stepping in and pouring fuel straight on the fire. We're seeing massive federal intervention right now, highlighted by a $2 billion U.S. Commerce Department funding push. This is aimed directly at front-running China and commercial quantum capability. And this massive influx of capital, it's heavily boosting pure-play quantum computing stocks. For example, IBM is getting a $1 billion match to launch America's first standalone pure-play quantum foundry, which sent its stock jumping 12%. And under the CHIPS and Science Act, you've got D-Wave Quantum and Rigetti Computing each receiving $100 million, with the government actually taking equity stakes. That news sent their stocks soaring 33% and 31% respectively. And this tech frenzy really culminates in what might be the supreme symbol of this entire market cycle, the upcoming SpaceX mega IPO. Expected in June under the ticker SPCX, this IPO is aiming to value the company at over $2 trillion to fund their massive AI ambitions and, ultimately, colonize Mars. Right now, the engine driving this valuation is Starlink, which pulled in $11 billion in 2025 revenue. But the future catalyst, the upper stage of this financial rocket, if you will, is Starship. It's designed to cut orbital delivery costs by 90%. That enables revolutionary applications like literal orbital AI data centers that can operate without any Earth-based utility bills. The culmination of all this innovation, euphoria, really boils down to one staggering number, $1.1 trillion. That is Elon Musk's total current wealth, assuming key Tesla and SpaceX valuation milestones are successfully unlocked. To put that into perspective, he already holds roughly $290 billion in Tesla stock and vested options, plus another $830 billion or so in private market SpaceX shares. But if Tesla hits an $8.5 trillion valuation and SpaceX hits $7.5 trillion with a Mars colony establishment, millions of additional shares unlock for him. It is the absolute peak of financial optimism. Okay, actually, let's execute a hard pivot right here. We need to slam the brakes on all this euphoria and look at the foundation of the actual economy, the consumer. We're seeing a vicious K-shaped retail divergence. On the resilient high end, Ralph Lauren is just thriving. Their stock jumped 13.9%, making it the S&P 500's leading stock. And they even raised their dividend by 10% because their luxury consumers are spending with total confidence. But look at the stressed budget shopper over at Walmart. Their stock took a 7.3% dive on weak full-year guidance because their consumers are getting squeezed hard by inflation and fuel costs. And here's the crucial warning sign, the real canary in the coal mine metric. Walmart gas station fill-ups just dropped below 10 gallons per visit for the first time since 2022.
That is a glaring indication of everyday economic stress.
And we're seeing a jarring visual disconnect that explains this K-shaped split perfectly. The blue line here shows the S&P 500 steadily climbing upward, happily pricing in all that tech and space perfection we were just talking about. But take a look at the red line. The University of Michigan consumer sentiment is absolutely plummeting. The Vibecession has officially returned. But you guys, this time it has teeth.
So the absolutely crucial point here is understanding exactly why sentiment is crashing so hard. This isn't like the 2022 sentiment drop where consumers basically just grumbled about inflation but kept right on spending because they felt their jobs were secure. No, the 2026 reality is a whole lot darker. Today's sentiment crash is being driven by fundamental economic fears. The survey's measure of 5-year job loss fear is hovering near its all-time high. Goldman Sachs is warning that this points to a highly likely decline in consumer spending growth in the second half of the year. Why? Because ordinary people are actively bracing for real income loss.
Section 1. The Fed under fire. Let's look at the central bank. So, a fragile, frightened consumer base facing soaring corporate valuations. That is exactly the highly combustible environment that incoming Federal Reserve Chair Kevin Warsh is stepping right into. He's facing immense, immediate pressure on 3 distinct fronts, which we've broken down here. First, the symbolism. Warsh was sworn in at the White House, actually becoming the first Fed chair to take the oath there since Alan Greenspan back in 1987, and he is facing heavy, very visible political pressure from President Trump to cut rates. But second, there's the reality. Inflation has missed the Fed's 2% target for over 5 years now, even while the labor market remains somewhat stable. And third, the market verdict. Traders are explicitly defying the political pressure for rate cuts. Right now, the market is pricing in a 58% chance of a rate hike by year-end.
All of this creates the ultimate market disconnect. Just picture a wildly unbalanced scale. On one side, we have the heavyweights of priced imperfection. AI capex euphoria, $2 trillion space IPOs, hopes for swift U.S.-Iran peace resolutions, and record call option buying pushing risk appetite to the 99th percentile. But sitting lightly on the other side, completely ignored by the market, is the fragility. We've got a hawkish Fed transition, consumers buying less than 10 gallons of gas at a time, record 5-year job loss fears, and mortgage rates sitting at 9-month highs. The market is pricing in a completely perfect soft landing, leaving absolutely zero margin for error in the second half of 2026.
Section 2. Defending your portfolio. Let's talk strategy.
Knowing that perfection is currently priced into a fundamentally cracking foundation, we really need a practical defensive strategy, something to protect your downside without missing out if the rocket ship decides to just keep flying. The briefings outline a strategy called the put spread collar. The strategic goal here is to hedge against a heavy pullback without having to liquidate your entire portfolio. So here's how it works in 3 steps. Step 1, the floor. You buy an out-of-the-money put to establish a hard price floor. This acts as your insurance against a heavy drop. Step 2, the subsidy. You sell a lower strike out-of-the-money put. The premium you get from selling this helps offset the cost of the insurance you bought in Step 1. Finally, Step 3, the funder. You sell an out-of-the-money call. Doing this generates enough premium to fully fund the rest of the protection. Now, keep in mind, it does cap your maximum upside profit, but the defense is completely paid for.
Because risk appetite is sitting up in the 99th percentile, call option premiums are highly elevated right now. That makes this a fantastic time to be a seller of calls to fund your puts. The data identifies the prime targets where this strategic shield is most effective today: U.S. tech, U.S. materials, U.S. energy, and Nikkei equities. In these specific sectors, the maximum payout ratios for this protective structure are currently exceeding 8x. As we wrap up this explainer today, I want to leave you with one final provocative thought. We've seen the absolute euphoria of $5 trillion tech giants and $2 trillion space ambitions, but we've also seen the everyday consumer struggling to buy even 10 gallons of gas, bracing for potential job losses. The extreme duality of the 2026 market really demands our attention. So, can perfection ever truly be priced in when the foundation itself is cracking? I invite you to carefully consider the fragile reality lurking beneath these record-breaking numbers as you navigate the months ahead. Thanks so much for joining me for this explainer, and keep learning.